Hi, I'm Sean Davies. This is the first YouTube video I've ever made for public dissemination. I'm going to call it Things That Are Important But Underappreciated. Quick background on me. I'm a finance professor at the University of Colorado at Boulder. Did my PhD at UCLA out in Westwood, California. Before that, I worked at a hedge fund in Chapel Hill, North Carolina. And I did my undergrad at CU Boulder as well. So I'm a diehard Buffs fan. So if you already are not on the Coach Prime train, you can dislike this video and just move on. That said, there's some market phenomenon going on that I feel like I have to speak to as a finance professor because it's really bothering me. It's a thing that's important, but incredibly underappreciated. And so I'm just going to walk through why it's important. And that is the current movements on the yield curve. So before I jump into why we should care about the movements in the yield curve, some folks say, oh, it's a treasury market. Who cares? I only am invested in stocks. But before we get to even that conversation, I want to play two games of would you rather. So the first game, okay, I'm going to ask you a question and I want you to pause and think about it. But the first question is, would you rather have me pay you $1 million today or pay you $1 million 1 year from now guaranteed? Okay. Would you rather have that $1 million in your bank right now or have it in a year in your bank account? Now, if you're like most people, you prefer that $1 million today. And that's because a dollar today is worth more than a dollar in the future. Okay. And this gets to the idea of time value of money. It's a really important concept as we start thinking about valuing financial assets. And now that I've entertained you with one game of Would You Rather, I'm going to entertain you with a second game of Would You Rather. And in this game, I'm going to give you a coin flip. Okay. Heads, I'm going to give you $2 million. Tails, I'll give you zero. Okay. So with 50% probability, I'm going to give you $2 million. With 50% probability, I'm going to give you zero. If we think about in expectation or on average, what we should get from that coin flip, it's $1 million. Okay, so we can flip that coin. You get $2 million if it's heads, zero if it's tails. But I'm going to introduce a second bet. And in this second bet, I'm going to just give you $1 million without any coin flip. So you can either gamble and get the $2 million with 50% probability or get $1 million with certainty. Now, in this setup, on average, you're going to get the exact same thing. With the risky coin flip, I get $1 million on average, or I get $1 million with certainty. And so in this gamble, which one do you prefer? If you're like me, unless you have some penchant to go to Las Vegas all the time and play blackjack, if you're like me, you'll probably prefer the guaranteed $1 million. Okay, and this gets to the idea that how risky a cash flow is also matters. So if we just take a step back and think about the first game of Would You Rather, getting money now versus in the future, and the second game of Would You Rather, where you had a risky gamble versus a certain thing, what that highlights is that there's two important things that determine the value of a future cash flow, money coming to you. And those two things that matter are when it occurs and how risky is it. And so when we think about comparing, say, money in the bank today to future risky cash flows we might get in the future, we can't compare those things apples to apples. And so if I'm looking at getting a cash flow, say 10 years from now, and sometimes it'll be higher than average or sometimes it'll be lower, I can't compare that to just money I have in the bank right now. And somehow we need to convert all cash flows to be equivalent so we can compare them on an apples to apples comparison. Now, if you've traveled overseas, you've probably encountered exchanging your currency for some foreign currency. Okay, so if I were to fly, for example, to Germany and convert US dollars to euros, I would apply an exchange rate. And so when we start thinking about this big concept of discounting, what we're doing is applying a discount rate. And that discount rate is going to convert future risky cash flows into current risk-free cash flows. That's all discounting is. It's an exchange rate, but instead of cross countries, it's between now and the future where there's a lot of risk and uncertainty. Okay, so I'm just going to jump to a PowerPoint slide real quickly. As you can see, I have really high tech skills. And so let me share screen, highlighting my amazing tech skills. Um, what we can say is that discounting cash flow is like applying a, applying an exchange rate, just like if you were to go to Europe. And the two things that matter are both when and how risky. That will determine the exchange rate. If something's really far in the future, the exchange rate is going to be lower. If something's really risky, the exchange rate is going to be lower. And what this highlights is that when we discount, we're sort of mashing two potatoes with one fork. Okay. And that's that we're going to capture both the time value of money, that I prefer money in my pocket today. And I also prefer things with lower risk, all else equal. So this discount rate is going to simultaneously account for both of those components. And so if we were to think about writing this as an equation, and there'll be very little math in this video, if we were thinking about writing this as an equation, we could write it the discount rate, okay, which factors into that exchange rate. It's going to tell me how much those future risky dollars are if I were to bring them back to time zero. That rate is composed of a time value, just the fact that I prefer money today over money tomorrow, and a risk premium, which accounts for the fact that I prefer certain things over uncertain things. So if I have to take on uncertainty, I'm going to demand a risk premium. And so we could take this one step further and say that that rate, okay, should be equal to the risk-free rate, what I get on a security purely because of the time value of money, and then a risk premium that's going to be how much risk I'm taking on and the price of that specific risk. Now, if you've taken an MBA or you have an undergraduate education in, say, finance or accounting, you've seen formulas like this through, say, the capital asset pricing model, CAPM, or multi-factor risk models. But at the end of the day, it's just the same thing. Risk-free rate for the time value of money, plus a risk premium for taking on uncertainty. Okay, so let's go take a quick look at a spreadsheet, and I'm going to show you what a discount factor is. So I'm going to pull up this spreadsheet. And what a discount factor is, the way that we actually calculate that exchange rate is we would determine what the rate is, okay, our discount rate. And then the discount factor is 1 divided through by 1 plus that rate, raised to how many years in the future we're looking. And then we just multiply those future risky cash flows by it, and that's going to convert them into being risk-free cash flows today. So that's how I calculate my exchange rate. And let's just apply it to a setting. Suppose I was going to pay you $1 billion in 5 years. $1 billion is a lot of money. And we assess that the appropriate discount rate, given the risk and the risk-free rate associated with that $1 billion, let's just say that that discount rate is 15%. Well, what I can do is I can calculate the present value of that $1 billion, which works out to be just under 500 million. Okay, so bringing that $1 billion 5 years from the future back to today, the fair value of that thing is about $500 million when we apply this exchange rate or this discount factor. Okay, and so that's what you'd be willing to pay today in today's dollars for getting $1 billion in expectation in 5 years. Now, why am I presenting this? Well, let's just look at what the yield curve has done. And remember that discount rate is a function of both the risk-free rate, which we often tether to US Treasury, thinking that the US Treasury is the risk-free rate, as well as a risk premium. But let's just go over and take a look at what the yield curve has done, particularly the 10-year yield, just in the past few in the past few months. So if I click over here, and I'm just going to CNBC, so you might love CNBC, you might not. But what you see here, if I look at just the 3-month perspective on the US 10-year Treasury, we see that back in May, okay, the yield on this thing was about 3.65%. You can see that now, okay, it's about 65 basis points or 0.65% higher at 4.318%. Okay, so we've seen a big increase, okay, in that discount rate, the risk-free rate, just over the last 3 months. And if we compare that over to just say how the NASDAQ has performed, and I'll talk about the NASDAQ in particular here in a moment. If we look at the NASDAQ's performance going back to May as well, we see that it's gone up. It's come down a little bit, but it's higher. Okay, the current level of the NASDAQ is higher than it was 3 months ago, despite this increase in rates. Now, why is the NASDAQ an important index to look at here? Well, typically in the NASDAQ, we have a lot of growth stocks, a lot of young firms that maybe are not profitable yet, but we're expecting that they'll be profitable in, say, 5 to 10 years. Okay, so that big payday for investing in some new IPO'd company or some young growth firm, we're expecting them to generate tremendous profitability, not today, but in the future. And that's the kind of stocks that are held in the NASDAQ. Typically, tech stocks, innovative stocks, okay, firms that have not sort of gotten to that status where they're just producing consistent, predictable profits. There's a home run, but it's many years in the future. So if we think about that $1 billion, okay, that we're getting in 5 years, that's kind of like a NASDAQ stock. Okay, and so we see that when we hit it with that discount factor of using a discount rate of 15%, okay, the fair value of that $1 billion was about half of a billion. It was about 500 million. So let's just go back to our spreadsheet real quickly. And remember, the 10-year yield has gone up by about 60 basis points in the last 3 months. So if I just go back to my Excel sheet and I look at a new discount rate, I'm just raising my discount rate purely by the movement in the 10-year. This is taking as given that the risk premium associated with these things is unchanged. So I'm just inflating that discount rate by 0.6%. Very minuscule, seems very small. And what we see is that the present value now declines to 484 million. And what that implies is that this investment, just with that slight change in the discount rate, should be worth 2.5% lower. Okay, we should have seen stock values fall by 2.5% just given this change in the yield curve. And you might say, okay, well, the NASDAQ's down. It is down slightly in the last few weeks. Okay, August has not been a great month for the NASDAQ, but not nearly as much as it should be, given that NASDAQ stocks are long duration assets. In fact, if we think about some stocks that aren't going to be super profitable for, say, 10 years, okay, maybe they'll generate some small interim cash flows, but they're not going to be really valuable for 10 years. So let's move this $1 billion out 10 years into the future. Okay, what we see is that small change, just that really small change in yields, only 0.6%, should make that thing worth 5% less. And we are not seeing that in markets. And so the big takeaway, okay, and we can actually go back and look at, say, the yield curve. This is what the yield curve looks like across all maturities. It's inverted right now, which is not a great sign in general for the economy. It suggests that the opportunity cost of capital, in terms of thinking about your investment opportunity set, is more attractive today than it will be in, say, 3 to 10 years. Not a great sign that the yield curve's inverted, but that's for another day. We can see that if we just hit these cash flows with higher rates, it should lower the values. This is important because we're not seeing sell-offs in equities like we are in the bond market. We're seeing 30-year bonds, 10-year bonds just get crushed, and it's not reflected in the stock market. So I'm just explaining why we care about the yield curve, why we care about US Treasury rates when we think about the stock market. This is an important topic, but very underappreciated. This is my first YouTube video, probably my only one. If you have other things that you're curious about or interested in, I'm happy to explain them, but that's it. I hope you have a great day, and I hope you invest safely.